Welcome, everybody, to another week of Wealth Wisdom, where we're helping you build wealth and legacy.
Companies are like an organism trying to survive.
It's always a risk when you're investing in a company that's purely tied to someone's brand.
45% of Americans have gone into debt for a Disney trip. Welcome to Wealth Wisdom. I'm Justin Obi, and this is Eric Benz. We're with Fox Hill Wealth Management. Today is the day one of our new podcast, Wealth Wisdom, Building Wealth, Building Legacy. We're going to talk all about everything you need to know about how to secure real freedom in today's world, where you control all your W's, what you're doing, who you're doing it with, where you go, what you're spending with true freedom. So really right now, today we're talking about our overall long-term philosophy and what makes Fox Hill different. Eric, there's like constant right now in the markets, there's a lot of fear-mongering. The stock market today is down 1%. How are you feeling today? Any talk with the clients? You know, is everyone freaking out or...
Oh, yeah. I mean, it's no matter what the stock market's doing, right? If it's up, everyone's saying bubble. If it's down, people are saying sell, get out. So it's a constant battle every time you're talking to clients. What we end up telling them, right, is stay calm, take a step back.
Yeah.
We're going to stay invested. We're not going to react emotionally to the news, to what's going on. But our job as advisors is we kind of bear the weight of all of this, right? We're the ones that have to worry about the market so clients don't have to. We're the ones up at night worrying about the stocks. But actually, I don't worry about the stocks we buy because we're buying quality companies and we're listening to analysts and we have strong conviction and we have faith in what the market's ultimately going to do.
Well, yeah, and that's what I wanted to talk about today is the first show is really diving into like why we at Fox Hill believe in the long-term health of the U.S. economy and why we, in innovation. And when we look at the stock market, I was actually reading a book lately. It's an older book now. I can't believe it. It seems like yesterday, but it's Unshakable, Tony Robbins. And it reminded me a lot about our philosophy in that we truly believe in the long-term efficacy of the U.S. stock market. And, Tony points out there's so many, over the past 100 years, of course, there's downturns. But if you actually tried to time the market, it really emphasizes the point of it's not about timing the market. It's about time in the market. And if you ever tried to time the market, you're probably going to lose out on most of it, right? So just staying in the market overall, best option.
It's an age-old, philosophy, right? But easier said than done when you've got a portfolio of $1 million and the market's down 30%. You've lost $300,000 and someone's telling you stay in the market. No, that's when most people are panicking, right? Yeah. However, that's when stocks are usually their cheapest. So I'll give you an example right now.
Yeah.
We actually had a client. This was in 2020 in the pandemic. Their business highly correlated to the restaurant industry, which was the segment that got hit the most during COVID. And this client, with his 401k, he sold out at the bottom of COVID. So market was down 30%, gets out of the market. And of course, hindsight's 2020. We know that it recovered 30% fairly quickly. It was a span of a few months, right? So that client missed out greatly. And a lot of what he was seeing was very local to his industry, right? Whereas other segments in the economy did very well during COVID. E-retail, tech, different areas of the economy. So I didn't know if you had anything to add there.
No, but, for sure. I mean, I think it reminds me of, Warren Buffett saying when there's fear, when everyone is fearful, that's when he likes to be the most greedy. Because, and actually JP Morgan had a study to go along with this. 6 of the 10 best days in the market over the last 20 years occurred within weeks of the 10 worst days, right? So moral of the story, if you got spooked and sold at the wrong time, like this example you're talking about, you missed out on all the fabulous days that followed. So in a way, market turmoil, it's natural to be fearful of it, but it's really nothing to fear. So, and I think that's part of our job as advisors. I am not an advisor yet, but you are.
Dude, I literally, you were talking yesterday and I was like, you should be an advisor. I was very impressed. You honestly were describing something better than I could. Because I've had clients panic and pull out of the market despite my best efforts. I actually pulled. It's funny. I pulled a few stats just to back up what you were saying. 5 to 10% downturns usually recover in 3 months. 10 to 20% corrections, 8 months to recover.
Yeah.
And then a bear market's on average lasts 15 months. Just so people know that.
Well, yeah. And I mean, I think, there's a lot of people, you start to talk to them about the stock market, and all they hear in their heads, unless they've already invested, they know, is risk. Oh my God, that's going to be so risky. And that's partly why, we have our own risk profile assessment that we have all our clients take. So we know how to diversify their stocks accordingly so they can mitigate risk. But there's just the general feeling of that. People are fearful of losing their hard-earned dollars. And what's amazing to me is that the time spent. So if the riskiest thing is actually not being in the market, because
Yeah.
you have inflation eroding away at your savings. So if you're fearful and you say, all right, I'm going to put my money on the sidelines in a traditional savings account, or even high yield savings account forever, and who knows how long those are going to last. The Fed's about to drop rates this month. You're losing money to inflation every single year.
Yeah, which it's hard to understand that, right? It's hard to visualize that. Maybe we can pull a visual, like overlay it with what you were saying there.
Yeah.
I actually pulled there's another graphic too, Justin. There's what you're talking about, right, where they're eroding value of your dollar.
Yeah.
But then there's also missing out on the power of compound interest when you are investing for the long term. So I actually pulled a data point. I believe this one was from an Edward Jones website. They talked about saving $550 a month, and they assume a 7% rate of return annually, which is like relatively conservative if it's an all stock portfolio. That's like a moderate return. And if you started investing at age 30, that $550 a month, by the time you're age 65, it's $990,000. If you start just 5 years later, that $550 a month, by the time you're 65, is $670,000. Another 5 years, $445,000. So that's a difference of like $500,000 if you start saving just 10 years later. And that's the power of the interest compounding on each other. So let's see if we can pull that graphic up later too.
Yeah, I'll pull it up right now, actually. So we got, so everyone watching this, you can see it right here. You've got, what Eric was just saying. If you start investing at age 30, right?
Age 30.
$90,000. It's a lot of money. Look at the difference there between 45 and 30. And that's another thing we're always talking about. It's like start early, especially if you're a current client, or if you're just listening to this and you're a new parent. It sounds daunting, like another thing to put away for, but you truly can set your child up for real financial success and freedom in the long run. And it doesn't have to be a lot of money.
No, we have clients do $100 a month in a education savings account, or for some clients that want more flexibility, they might do it in a UTMA account, Uniform Transfer to Minor account. There's all different vehicles and all different amounts parents can save, but the key, it doesn't matter what amount you're doing, like you said, the key is just to start as soon as possible and let compound interest do its job.
Coming from the outside and into this world right now, for me, I think most of the job that we help our clients with is coach, right? Like not just the strategy and the tech, the know-how, right? How to make a plan, how to make a financial plan, the tax strategy, the estate planning. Of course, that's all there and part of what we do. But the other, it's like an emotional piece, right? Like keeping people in, most people, and if you're listening to this, think about this yourself. When the market is hot, it's so easy to be greedy and say, all right, well, I'm going to just keep it in a little longer. It's going to grow. That's probably when you might consider selling if you're actively trading. And if the market is completely shit and it's down rock bottom, and someone's like, hey, it's actually when reality is probably the best time to enter the market would be, you're like, hell no, I'm not going in right now. The human emotion when it comes to investing is quite interesting to see at play. And I think that's another big role we have in serving our clients.
And the reason for a lot of that, obviously the emotional part is incredibly difficult, but the reason that we want to get in the market and stay invested at all times, is because we ultimately don't know what's going to happen.
Right.
But for those that do have funds on the sideline, getting in after a downturn essential, because the market tends to recover more quickly than the economy. It's a forward-looking indicator.
Yeah, and that's always very fascinating as well. How forward-looking it is. If anyone's telling you they know exactly how to time the market, you should probably run the other way. We certainly can't, and so
no. And we're not experts either. Like we're looking at analyst research. We're not geniuses. We're not genius stock pickers. We're listening to the analysts and going from there. We're letting them tell us what to do, so that we're not taking giant risks with our clients' funds.
I think there's real, like, just diving into the economy right now. I think, everybody, when you just looking at this past year, right, even the experts don't really know. Everyone thought that the Fed was going to cut rates 6 times this year, and they haven't done it once. They might, there's more data coming out. They might, Jerome Powell saying, hey, let's maybe timing is right. Let's consider cutting rates. And now, there's talk all over, is he going to cut 25 basis points? Is he going to cut 50 basis points, 75? No one really knows unless you're, Powell or maybe
Right.
a Fed chair as well. But
Well, they may not know too until they get all the data in, right?
that's right.
I was actually listening to an analyst talk yesterday,
Mm-hmm.
and they were saying that a lot of them come in with, it's a debate when they do meet the Fed, and a lot of that data doesn't come in till the last week. But this analyst in particular was saying, I think they wouldn't give a straight answer, but I think they were leaning towards a 25 point basis cut. And what some investors and like kind of general world is worried is, okay, maybe there's some data points that come out, and if the Fed decides, oh, they need to cut 50 basis points, maybe they're seeing something that's a little alarming, like a slowdown in the economy,
Mm-hmm.
but decent amount of relatively strong data, and they think it's only going to be a 25 basis point cut. Like, they don't need to hurry up and cut in order to save, keep the U.S. economy rolling.
Yeah, and I don't think you bet against the U.S. economy ever. It's
No.
there's so much innovation here. We're lucky to be here. So it's and I think that's true. But everyone likes to, if you listen to all the news, the past, I think it was the jobs market report came in, 2 weeks ago, and it was underreported that in reality there was 816,000 jobs that didn't exist. They were just like, the data was wrong. And people heard that and they're like, oh my gosh, they were calling for an emergency Fed meeting to cut rates, and none of that happened.
Right.
And the economy is still okay, and we're doing well. In 2017, we had been in a bull market for 6 years, and at that point people were calling for massive recession. And if you had listened, you would have missed out on probably gains of pretty extraordinary numbers.
What is the, oh my God, yeah, probably returns of 250%,
Yeah,
300.
I think that's
almost, it. Right?
Yeah.
Wow.
And so again, like, going back to that point, is if you're out of the market, that's the riskiest thing, because while the stock market has been going up, and it's not just money piling in from the U.S., it's worldwide. People pile into the U.S. economy, our stock market. But we had reported, 9% or double-digit inflation 2 years ago. And everyone listening to this knows how expensive the grocery bill is getting. And so, like, it is a real inflation. Inflation is guaranteed. You're always going to have inflation.
Yeah.
And it's hard to work your way out of inflation. So you have to be investing.
I think inflation was the number one issue that all voters are looking at, actually, for this coming election. It was inflation, immigration, and then like body autonomy, right? Abortion. So it'll be very interesting to see how all it plays out. But what's funny, right, is who's truly controlling inflation is the Fed. Yet it's this topic, which I don't want, you know what? We can go out of order too. I guess we can get into it now. I had some of that government stuff at the end.
I know.
But this leads right into what role, like, how much of a role does the election play in what the market's going to ultimately do, right? Democrat or Republican? Should we panic if one side wins versus the other? Should we panic leading up to it? We know there's going to be a lot of market volatility. It's election season, right?
Yeah.
Market hates uncertainty. Hates uncertainty because it's forward looking. So we don't know who's going to be elected. We don't know what their policies are going to be ultimately. They're all politicians, right? They flip flop what they said a few years back, what their policies were. However, the main issues that they're all focused on actually don't affect the economy that much, right?
Right.
A lot of it's social issues. So I don't know if you've been reading about any of those social issues, Justin.
No, not really.
Okay.
I try,
sorry.
I think, low information diet, I think, is important for folks. And I try to follow that. And if you're trying to drink from every fire hose, it's hard to. So I'd like to focus on true things that matter. I think that's where you're going. And, like, the election, it doesn't truly matter. And, then I think you've got a stat poll.
Tell them that stat. It's very interesting. And
Yeah.
I believed it to be true. And it was nice to see that it, yeah. Do you have it pulled up in front of
Yeah, so
you?
I think unified Republican government in their 13 years, the S&P returned 14.52%. And then when it was a unified government, which has been for 36 years, which is also kind of surprising. I didn't realize
14%.
that. It's
Yeah.
14%. So no matter what, the S&P actually doesn't care whether you're Republican or Democrat. That's the
Yeah.
takeaway.
Isn't that amazing?
It
Because
is.
everyone would tell you otherwise, right? And ultimately, it's up to the Fed. The Fed is the one driving the economy.
Yeah, well, that personally, I've heard it. I heard it first from Tim Ferriss, and it
Yeah.
was about the low information diet. It's so powerful. So if you think about how much fear is pumped into the market by headlines, and you can't blame them. That's their job, right? To sell the press, sell attention.
Right.
Most of it never comes true. And if it's really that important, you'll probably hear about it from your friends. And so, like, you actually don't need to digest everything, especially if you have an advisor working for you, because if there's something that needs your attention, they're going to pull you into the arena anyway. So it's like it allows that having that power and knowledge, you can kind of focus on the things that really matter. And I think it ties really well with, what we like to promote is building a lifestyle of freedom.
Dude, that's amazing. That was a great tie back. Wow, you're really
Yeah.
you're on your A game here.
No, it's
It's
it's it's so true, right? It's the same stuff with the market. Everyone freaks out, and it's so hard to invest when it's down. But when you look at the data, the real facts, it's the best time to jump in because it's always going to
right.
come back.
Yeah. And I don't want to minimize. I know, like, I think sometimes when I come off saying that, oh, it doesn't matter, Democrat or Republican, oh, the news doesn't matter. Like, we're definitely looking at all of those things, right?
Sure.
And those social issues definitely matter to us a lot too.
Well, as
But when it
humans, yeah,
comes to, yeah, right. But when it comes to, our clients' portfolios and, their performance and their success in retirement, those things do not matter to us.
no, and then that's our job's not politics at all. It's our job is to work with our clients because Republican or Democrat doesn't matter. Everyone wants the same thing, right? We all want comfortable retirement that meets or exceeds our standard of living today. We want to protect our loved ones. We want to be able to care for them. We want to probably pay for our vacations and treat our family members with fun things like that, and to build memories with them. And so investing is the way to do that. But also, what I love about Fox Hill and why I've jumped in with you guys here is the whole, the 360-degree approach combined with the low fees. Like, I think that's massive because fees can burn you,
Correct. Yeah.
you know?
Yeah. We actually use the two custodians we work with are very competitive custodians. Charles Schwab and Altruist is the other one.
Mm-hmm.
The way we invest too is tailored to all of our clients. So not
Yeah.
only are we picking individual companies and designing portfolios for our clients, and the other side of it too, which you're talking about, the financial planning side of it.
Yep.
We have 3 CFPs on staff, and they use financial planning tools to help people run retirement projections, figure out best ways to save, figure out how they can enjoy their life. And that's where the biggest value add is. Because we can just
For
sit
sure.
there and invest for somebody, but unless you know their life story, you're doing them a disservice, right?
That and, coming out with a financial plan because lifestyle creep is real. And oftentimes where you make a little more money and you spend more money. And so you're never actually getting ahead. So having a plan with your advisor who they're fiduciaries. And for those listening who have never heard that term, like, we're legally obligated to do what's in the best interest for our clients, which most advisors, not all advisors, have to be. And that's kind of the interesting piece is, my father dealt with this. He was a CFP back in the day, and he wouldn't sell the insurance products that they wanted him to sell because they actually weren't good for his clients. Regardless of, he would have made a ton of money, we would have grown up wealthy, but he wouldn't do it. And so I like that a lot about, our philosophy here at Fox Hill is it's a low AUM only assets under management fee. And
Correct. Yeah, we're not selling any product. It's just a
yeah,
assets under management billing model. Correct.
That's right.
which fee only is what's on the website. Don't forget that.
Right, fee only, which means like we're in it to win it with you, and there's no like we're not like a hedge fund where they take a percentage of profits on top. AUM fee of 2% in the hedge fund model, and then it's profit of like 20% of all the profits. So no, it's just simple,
Yeah, if you have
flat.
a good year, a hedge fund's taking a big portion, right?
Right. Yeah. So they really, I mean, if you're doing that, you have to win big, but you're going to the casino oftentimes. But yeah, I thought that was really interesting what you had brought up. What do you think of home prices right now? Like a lot of people have been talking about that.
Yeah, well, I wanted to jump into that actually. I'm glad you brought that up because we were talking about financial planning and then
Yeah,
which honestly, home affordability been a big reason for a lot of the inflation, right?
that's right. Yeah.
U.S. home price growth is predicted to finish up 4.7% this year, and that's for I believe it's for homes sold, and then it'll slow in 2025 up 3.1%. So home prices still growing despite like them growing over the last 4 years like 35%.
Yeah.
So here's some stats for you. Average home price sold for US homes in 2020, 371,000. Now the average price in Q2 2024 is 502,000. That's a
Wow.
35% increase, right?
Wow. And that's a
So
national average.
yeah, and it's a supply issue, right?
Right.
People my age, first time home buyers, are having trouble buying homes, right?
Yeah.
I'm a 30-year-old, and I think it's like the average amount you would need to buy a home is for people in my generation, it's about like 40% of their take home, their monthly take home from work. So if interest rates do come down, we may even see home prices keep creeping up.
Yeah.
However, if interest rates go down, mortgage payments will be cheaper. So talking about affordability, right now, let's say you're paying 7% interest on a home that you bought for $500,000. You're gonna borrow 400 grand, right? At that 7% interest rate, you're paying 2,700 a month.
Wow.
Okay, if interest rates come down to 4%, let's say 4%, bringing mortgage rates to 4%, let's say, and you buy a $500,000 home, $400,000 is what you're borrowing for your mortgage. You're gonna be paying $1,900 a month. So it's 30% less than that 2,700. A lot more affordable for people my generation, which might cause more people to enter as buyers in the housing market, right? So
Yeah,
it'll
I
be
think
very
that's right.
interesting to see what happens in the next couple of years as interest rates do come down. A lot of it depends, what speed is the Fed gonna do that at?
I think that's been the most amazing thing to watch in the housing market is over the past 4 years, you had historically low interest rates, right? You were able
Yeah.
to get a mortgage for, 2.875%. I think might have been the lowest or 2.8. And the Fed raised rates. So now like the best deals out there are hovering around like 7, 9, 8% mortgage rates, unless you have a special situation, but I'm pretty sure that's pretty average across the board. And home prices continue to go up. And you would think just understanding basic economics, supply and demand, prices going up, usually demand drops, assuming a steady supply. But basically, price shot through the roof right now. And then what you had is, a lack of supply in the housing market across the board. You have more people because boomers are not leaving their homes. They're living
And a lot of them own
longer.
2 homes. That's another stat,
They
which is
own
very
two,
interesting.
maybe
Yeah.
three homes, An Airbnb is not helping the situation. You have, people who are buying, 3, 4, 5 homes, but there are short-term rentals. You have a lot of factors coming into play, and it's driven prices through the roof. So it's pretty good for homeowners, although you're getting taxed on unrealized gains as your property taxes are going up, which is a whole other hot topic.
Yeah.
But
Yep.
we'll save that for next round. Or maybe later. But yeah, it's fascinating. And so I think if you can find a home right now that works for your budget today, in fact, check me here, but you should be able to buy it now, and then you can refinance it as rates come down over the next 5 years.
Yeah. Some people have done floating rate mortgages too, basically betting that interest rates will come down, which is another option as well.
Oh yeah, totally. They could go up too, and they probably won't. But
Yes, it's a risky option.
well, you have, I mean, just speaking commercial real estate, you had a lot of people who had to get, they got adjustable rates 2, 3 years ago, or even longer ago on the commercial side. And, a lot of financial or real estate experts, and this is, a little side tangent here, but, you're going to have a lot of that starting to adjust upward. People say that will cause a lot of pain in the market, where prices are falling, rents aren't supporting the new higher rate. Landlords can't just crank rents up. If it's a commercial multifamily, you can't just increase rents on tenants, in real time. Tenants aren't going to appreciate the move out, or they're locked into a year-long lease, right? So you can't really do it at all. And so, but yet you still have to float the higher rate because those all just turned. So it is fascinating as a little side tangent there. Yeah, no, I think how do you address that affordability right now? Like, how are you talking about that with your clients? Are you encouraging like more saving? Like, all right, let's make some lifestyle cuts to get there.
It's all fronts, right? It's
Yeah, austerity measures.
right, trying to save, trying to live somewhere where the rent isn't quite as high as you try to build that little amount you need for your down payment, right? It's also investing. For some people, I've opened high yield savings accounts mixed with individual investment accounts that are taxable, where you can invest in the stock market, but when you do need to take out those funds for your first time home purchase, we can liquidate those and get those out next day. And part of our services is we actually also will wire funds out to the escrow account, whatever the attorneys have on file, for our clients, so they don't have to worry about sending the money out themselves. That's just another like high touch kind of added benefit we'll do for them.
Yeah, that's huge.
But it's not easy, right? So a lot of it is some financial planning. Will help our clients, younger clients, come up with a savings plan for their first time home purchase.
That's great. And I think that's so important to have that plan again, because I remember my 20s or right after college, and there were a lot of great nights. Like, I don't regret them. Great nights going out to the bars in Boston and having a ball, but they weren't cheap. And I could have put a ton of money away and invested it if I had a financial advisor at that time. And I just didn't think I could afford a financial advisor. And I think looking back, the fact is I probably could have not afford, should have had one, which is,
I don't know. You're pretty smart yourself too, though. Yeah.
Yeah, sure.
Yeah.
But it wasn't, I could have been a lot further ahead, and
right.
Of course, looking hindsight's 2020, but that was when Meta IPO'd when I was like 21, could have invested then. Amazing.
So that one was an interesting one there, because I might be totally wrong. We'll fact check this later. I think it IPO'd at $40, went down to 20. A bunch of people panicked, and then it just rallied up from there over the years and was.
It did. I think you're right.
A good investment.
I remember that. I'm just pulling it up right now. I think it was Facebook's IPO, $38 a share.
Yeah. Did it go down to 20?
Yeah, I can't.
I just remember it because we had to do a bunch of paperwork for clients that wanted to get in on the IPO. This is at like an old firm I used to work at, also a boutique advisory. But another company, one of those ones not to get panicked when it goes down. They just have such a strong moat, right?
Yeah,
basically
huge
a monopoly
moat,
almost.
Incredible moat. I mean, so if you jumped in, even if at the $38 a share, and if you just stayed there, today it's trading around $500 a share, right? So the cumulative gains is 1,200%.
Yeah. Wow. So we own Meta in our journey strategy right now, which is that long-term invest in growth stocks, have high conviction. Even though there's a little bit of volatility, we know they're great companies. So Meta is actually one of those companies we hold right now.
Yeah. I mean, and for great reason. You can't really beat them. So many, TikTok came in and tried to eat their lunch. Snapchat tried to eat their lunch. They bought Instagram when they were just Facebook.
Threads, right? Now they have Threads. I don't know how well that's doing.
They're pushing it very hard.
Yeah.
So I think, you can't, it's hard to bet against Meta. They have such a great brand, a moat. And it's very sticky. Like, what they sell is very addictive. For investors, it's a good thing. I think, you can debate how good it is for society. But,
right.
but it is great. So I love that approach as well. And that's the type of stuff we're always looking at. The other last piece, did you see the Chase check glitch recently
Yeah, I did. My wife
this
showed me
week?
some of the TikTok videos. Yeah.
Yeah, on Monday
Pretty
it
amazing.
hit
Yeah.
crazy. I mean, if people seriously thought that would work, and it's unfortunate, you know.
Can you tell people what was going on for
Yeah,
some
so if
people
you
that haven't
haven't
seen
heard
that on like
about the
social media?
Chase, if you haven't heard
Yeah.
about the Chase check glitch, people were able to go to ATMs and withdraw money from their account that just wasn't, they didn't have in the first place. And they thought they were rich, and it was exasperated on social, whether it was true or not. You had videos going viral of people throwing money up in the air near a Chase ATM, and it was this massive, massive, massive. It went viral. What ended up happening was obviously JP Morgan figured it out and nipped it in the bud, and now these people are. It's not only bank fraud. It's they have to pay that money back. They have negative balances now in their accounts.
Yeah, what is even the takeaway there?
I think that no, I think the takeaway
There is no
is
get
like
rich quick scheme out there.
it's kind of like, yeah, there's no get rich quick schemes.
Yeah.
There's no free lunch kind of thing. Like it's like
Yeah.
if it's too good to be true, it often is. And so I heard that, and I learned that investing myself. And if a deal is to be rushed, you should probably just pass on it. If someone's pushing you, like, you have to invest, you have to invest, you have to invest, get in on this deal. It's super awesome. It's not gonna be here for much longer.
Right.
Like, you should take your time and not jump in and not listen, because if it is a real deal, it's going to be still there. The
Right.
high pressure sales, never succumb to those. You should never do that. But yeah, I think the takeaway is don't be an idiot. Like, of course you didn't have that money,
I don't even think it's a glitch too, because like when we pull in funds from a client's bank account to Schwab,
Yeah.
like they'll post the funds instantly, right? Like if I pull in 10 grand from someone's checking account,
Sure.
Schwab will show it available same day, and we can actually buy stocks right away. However, you can't send money out of that account anywhere. It takes like 2 to 3 days to settle in the account. So I'm sure that was like the same thing going on. When you put that check in, some of it settles.
Well, that was the
takes
other
a few days for
piece.
it to actually post, right?
Yeah, and I think that was the other piece. I mean, it's pretty bad what they were doing. Yeah, it's really bad. And you have to take personal responsibility. Like, you can't just say, like, "Oh, I didn't know." Like, of course you knew this was wrong, right?
Yeah.
And so it is interesting. I can't believe it was a thing even. So, and everyone was talking about it.
Bad lifestyle choices, right?
Yeah, I mean,
Speaking of lifestyle choices, is there anything you've been doing to make yourself better recently, Justin?
yeah. Well, we were talking about 75 hard challenge.
Yeah,
Yeah.
yeah.
That's funny you brought that up here. Yeah, I guess it's all part of the pod. Because you know what? So why I do it, I strongly believe you need full energy, right, to be the best you can be every single day. And part of that for me personally is health. And so health and fitness, I've had a lot of days in my life where I felt too busy. Days where you wake
Right.
up and you're like, oh my, I have so much to do. I don't have time to work out. And for years, I grappled with that. I just wouldn't work out. And because I felt like if I was working out, I was betraying my clients or my coworkers. I wasn't getting in first to the office or whatever. And I wouldn't have time to do all the work. And at least for me, when I'm at my peak performance from a health and fitness standpoint, not only can I focus better all day long, I have more energy. So my max output, although it's fewer hours, right? I lost an hour working out, but that 1 hour maximizes the rest of my day and makes it more efficient. I can move faster and think better, and serve clients best. And, so that's always, I finally got to that point in my life and I was like, okay, cool. And for me, I like finding the random challenges that keep me motivated and push me further. So yeah, I just jumped onto the 75 challenge, man. And it's been great so far.
That's a great way to think about it. I've always thought about like working out as like a selfish thing.
No, I think
But
it's the opposite.
yeah, yeah,
Yeah, I think that's true. I think it's actually selfish not to work out.
right.
Like, and even like you're about to have a baby, and when you think about it from like your family's perspective, right? Like it's very selfish not to work out because if you're sick all the time, you can't really care for your family. If you die early, that's not no one wants that either. So like making health and fitness is a priority, and so for me, it's like health, fitness, and finance.
Yeah. The other thing too, beyond being there for them is you being like a really good role model, right?
Totally.
If they
Yeah.
see you working out and getting up early and starting your day and being competitive and all that stuff, right? You're leading by example, which is
Yeah.
probably like the biggest thing. I've been, with my kid on the way, I've been trying to read up and think a lot about, what it means to be a good parent and all of that. And like a lot of the stuff out there, obviously there's gazillion books, right? A lot of them talk about some of the most important things is how you take care of yourself and then
Hmm.
how you interact with your spouse. Like that's what the kids are looking at. They're watching you all day, right? Are you respectful? Are
Yes.
you
Yeah.
thoughtful? Do you take care of each other? All that stuff. So anyway, sorry. Yeah, that was
No,
like,
that's well, that's a really
but
interesting point too. It's like they are
yeah,
watching, that,
yeah,
and that's probably your behavior is the most effective. You can talk to them and tell them what's right, but
right,
modeling the behavior is even more powerful for sure.
yeah.
But yeah,
And
you should. I keep trying to get you to the 75 hard with me. Maybe.
I, you know what? Maybe I'll do 75 and a half hard where I do one workout instead of like two.
Yeah, they
That'd be
yeah they call it. I think 75 soft. I've heard it
Oh,
called.
sorry. Dude, I'm a moderation in many things kind of guy.
Yeah,
So,
that's good too. No,
but,
I'm not hating
but
on it. For me, I need an extra challenge, whether it's like training for a triathlon and signing up. Back,
yeah,
I signed up for a first marathon. I had only run, 5 miles ever before, and I was like, it took me signing up for a marathon and raising money for MS to
yeah.
run the Boston Marathon. So like I wouldn't have done that.
So
So
I didn't know you did that.
yeah, yeah. But it's again
Wow.
like I only bring it up because like for me, I just need the challenge of something like a big goal.
Yeah,
Um,
you've always done just from what I've known you like a few months now, right?
almost a
And
year, man.
and I learned that well, I mean like we would interact like a couple times a month
No,
when you
yeah,
first
yeah,
started your
yeah,
services with us and then you
yeah.
came on full time and I've gotten to know you a lot better. When you said you were a Red Bull rep in college, I was like you 100% were a Red Bull rep guy. Like that was amazing. Yeah.
Yeah, it's a lot of fun. Yeah, man.
Yeah.
So
You
good.
literally you drove the like Red Bull car, right? That thing.
Yeah, yeah. Learned a lot in that
Yeah.
job. I think, for me, and I'll just tie this all back. I think you only have, this one life to live, and you got to live it the best you can. And, I don't know if this offends anybody out there, but like having money makes that helpful. It makes it all possible. And so, I've always approached it like work hard, play hard, and be smart with your money. And I think part of what I've learned in my 40 years here is that on this earth, it's like you got to build the team around you, right? And like it's okay to say, hey, like this is not my thing, and I got to bring in an advisor here. And that's kind of why I love it. Is like Fox Hill offers all of that, and that's why I decided to join the team. But it is it's not to be an ad for Fox Hill for this show, but it is like if you're looking at your life right now and things aren't clicking, whether that's health or financial or whatever it is in business, I think bringing in an expert is a smart approach to getting things in line quicker, and being able to differentiate, having discernment between what's real and what's not. And the market's emotional, and if you're trying to do it yourself, it's like it's tough to stay in on those hard days, and it's much easier to push it off to you.
Yeah. It dude. We life is very difficult if you live it without coaches, without mentors, without confidants, and
Yep.
the same thing applies to your finances.
Yeah.
Actually, even like on a This is a more specific example. This is at my old firm. We were meeting with a client, and he made an analogy about what a financial advisor is. And he said, oh, like if my drain is broken, I'm gonna have a plumber come and fix that. Like I could look it up
Yeah.
on YouTube and figure it out myself, but I want it done correctly. I want to know that it's not going to leak again. I don't have time for that.
Yeah.
I'm going to have a plumber do it.
Totally.
Like a lot of advising is the same way. You can look up a lot of these different things, but at the end of the day, you want to make sure it's done correctly and that your family's taken care of. And
Yeah.
that's what Fox Hill is kind of there to do for you.
Oh, for sure. And again, I think it's obviously expertise in, estate planning and financial planning and investing, tax. Half of it's like, we put out free information all the time on our blog, our Instagram, YouTube channels, right? Like we're this podcast, but you can hear it sometimes, but you need, oftentimes you need more reminding than you do, and you need a coach to help you through those hard times. So it's kind of how I look at it. Anyway, this is a great first episode.
It was very nice.
Yeah. If you guys are listening, you're still here with us, send us an email and let us know. Put that in the comments right now, but love to hear about your feedback and how we can improve the show for you. This is the first of many to come. So appreciate you being here on Wealth Wisdom, and until next time.
And comment with any ideas for episodes. I know we're talking about some lifestyle stuff and interview series with small business owners, and I just want to say we're so excited having Justin on the team too. He's been really great so far, and I think we're going to do really big things with him. So thanks again.
Sweet.